Charitable contributions, gifts to charity. These fall under itemized deductions. They are individuals making a contribution. So remember on your itemized deductions, these are all personal deductions. Which schedule do they show up on? Schedule A. Are they a for or a from AGI deduction? From. Okay, hopefully you've got that down really well. So first of all, before we get into some rules, we need to know what is considered a gift to a charity. And so the IRS has listed a few things. You might have heard the term before, 501c3. That is because we find out in the Internal Revenue Code under section 501c3, it lists some things. But there are other sections of the Revenue Code as well that allows you to give a gift to charity and take a deduction for it. So 501c3 are typically things you've heard of before, like the SPCA for animals, CASA, a nonprofit that helps foster children, American Cancer Society, things like that. But there are other things listed, such as you can donate money to your state or local government. You could give your police department money to go out and buy new vehicles with, or new canine dogs or something, and that's deductible. Certain cemetery organizations. So read through that section and know that it's more than just 501c3s. Okay, now, again, we'll get into a lot of rules, but there are a few things first that says, how do we have to tell the IRS? How do we prove that we gave this money away? So there's substantiation requirements. And if you make a donation of 250 or more, then you have to receive a letter from the charity saying, hey, Jennifer Reynolds gave us this money and she did not receive any goods or services in return. So in other words, I'm not buying something from like a retail boutique like Goodwill that sells clothes. I don't get to deduct that because I got something in return for it. So this is cash or non-cash. If I give to someone, I'm going to have that receipt. I don't send it in with my tax return, but if I get audited, I have to prove it this way. And then next we look at, so this is, let's see, I didn't write that, cash or non-cash. We've got to have that letter. And then now if we give a gift of non-cash property, and it's 500 and up, we have additional substantiation. So the IRS is going to make us tack on another little form to our 1040, and we're going to give some more information. And so examples here are sometimes like people donate things to Habitat for Humanity or Goodwill, and you give away a bunch of furniture or clothes or something like that. You're going to fall under here and need this receipt if it's over 250. But then if it goes over 500, we're going to have to add another form onto the tax return and tell the IRS some more information, like how long ago did we buy this stuff and how much did we pay for it and what are we trying to deduct now? In public accounting, this is the area that just always cracked me up. People want to take $1,000 donation for donating 10 pairs of their 45-year-old nylon busted up pants, or their 100-year-old couch with cigarette holes in it, or whatever. So this is what the IRS is trying to tamp down on here. So those are the first two. Then the third one is if you donate something worth more than $5,000, or you're taking a deduction of more than $5,000, then it also has to have a qualified appraisal attached. So that means an independent party. Say I donate a piece of artwork that's been hanging on my wall, and I go, oh, that's worth $10,000. I'm going to have to go and pay an independent appraiser to write me a professional certificate up that says, yes, this is in fact worth $10,000, or else I can't deduct it. And then the fourth thing, excuse me, is not an actual amount, but it has to do with vehicles. So many people were saying, oh, I've got this jalopy in my driveway that's never going to run again. I'll donate it. You see those billboards, cash for cars all the time. And yeah, that was probably $10,000. Knowing good and well that car's never going to run again. The company you donated it to is just going to scrap it out take it to a scrap metal yard, get some money for the scrap metal, but it wasn't gonna be anywhere near 10,000. So now there's a rule that says if it's a vehicle, you have to wait for the charity you donated it to give you a bill of sale, and you may only deduct exactly what that charity sold it for. Okay, there's that. Now let's switch over and talk about if we contribute property rather than cash, and we've got some different rules. Okay, I have some new stuff on the board for when someone gifts property rather than cash. We've got two different rules to think about here, and I want you to really think about this because I see students kind of not put enough thought into this on an exam. They're just thinking of the rule they learned and not really reading into the type of property. So this first one says capital gain property. What does that mean? Well, for purposes of this, you guys know what a capital asset is. It would have to be a capital asset. And then for purposes of this rule, it would be held long-term. So how long is that? I hope you didn't say a year. I hope you said over 1 year. And so how much can someone who gifts long-term capital gain property deduct? Well, generally they get to deduct the fair market value of the property. And we'll do an example where you can see this more clearly. So then what is ordinary income property? Well, it could be a capital asset, but you did not hold it long-term. So short-term capital gain property or loss property, okay? So that's the first thing you do. Identify when you're reading the question or talking to your client. Wait, what kind of property are we talking about here? Stock? That's a capital asset. How long have you had that stock? 11 months? Oh, that's ordinary income property. That's not capital gain property then, okay? So ordinary income property, we deduct the lesser of fair market value or adjusted basis. Okay, so look at this problem over here. Say I have a client who has some stock that today is worth fair market value, $4,000. She bought the stock, her adjusted basis is $1,000. If she just went out and sold that stock today, y'all, she would have a realized gain of $3,000. And for tax purposes, she would recognize a $3,000 gain, meaning she would pay taxes on $3,000. And then she's got whatever's left in her hands, and she can either go shopping or be a good person and donate it to charity, right? Well, what if we told her, hey, client, if you've held that stock for over 1 year and you're going to give some money to a charity anyway, here's what I suggest. Rather than selling the stock and giving it to the charity, because now you'd have to pay taxes on the $3,000 if you did that, there's a special rule that says you can gift it and get to deduct the full fair market value of $4,000. Well, if I was going to give them $4,000 in cash, I'd get that anyway. Whoop-de-doo. Where's the benefit here? The benefit is your client would not have to pay taxes on that gain. Ta-da! So it's a great way for people to make large contributions without paying taxes on the appreciation of whatever that property is. Maybe it's some land they held in their family for a long time, and it was worth $10,000 when they bought it 50 years ago, but now it's worth $400,000. So again, rather than selling it, if you gift appreciated property that you've held long-term, sure, you get the deduction. You're going to get that whether you give cash or property, though. The benefit is that you get to skip out and not pay taxes on that gain. So now let's say I've got the same client, but now she has only held this stock for exactly 12 months. She comes to you today. It says, today's the day. I've held the stock for 12 months and I'm going to sell it, and I'm going to give this money to CASA, court-appointed special advocates for foster children. What do you tell your client? Wait, not today. Let's wait. If you wait 1 more day, then you will have held it long-term, and fine, you still get the same deduction, but you don't have to pay those taxes on it. So those are your property rules. And then I have one more thing I want to cover. Okay, I lied. I have more than one thing. So I wrote a list on the board, and then I want to work a problem for you at the end. I didn't mention unrelated use property. So if a donor gives property to someone and that charity doesn't put it to a related use. So artwork is usually the example you're going to see here. Say I have a Monet painting, and I give it to, I'll use Casa again because I've used them before. And Casa they don't want this Monet painting in their office. They'd rather sell it for $50,000 and put that money to work. Then I cannot take the fair market value of it. I can only take that adjusted basis. So that would be an example of I don't want to donate that to Casa. I'd rather sell the painting or find something else to donate or give the painting maybe to a museum that would put it to related use, okay? So then there are some overall limitations for your charitable contributions. And ultimately, remember, all of this has to fall under itemized deductions and would need to be greater than the standard deduction, or you're not going to take it anyway. If out of all of your itemized deductions, you just gave $100 to your church this year, you're not going to end up itemizing. So, okay, your overall limitations. One, there's a 50% of AGI limitation. Means you cannot deduct more than 50% of your AGI. So you go, God, who's doing that anyway? I'm giving away half of my income? Well, think of older people who are retired. They may have a lot of money in the bank, but they don't have a lot of taxable income. And they've built some accumulated wealth, so they're going to start giving money away. So they're limited to just 50% of what their AGI is that year. Now, during the TCJA years, this amount was increased to 60% of AGI. So that is set to expire in 2025. Okay, and then we have, and I'm going to work a problem on this, a 30% and a 20% limitation. Generally, this 30% limitation is on capital gain property, and the 20% limitation is for private non-operating foundations. So if you're in my class, I don't go into those a lot. If you're in another class, then your book definitely discusses this and you may need to do some more research in that. And certainly it's very relevant. We just don't have time to cover everything. So I typically mention it and don't give you a problem on this one. So I'm going to put a quick problem on the board and show how these limitations come into play. Okay, I've got some facts behind me. Say your client comes to you and says, hey, I want to give this stuff to my church. I want to donate $2,000 in cash to them. And then they need some land to build a new church. And I have some. I've held this land for 4 years. And you go, well, what were you using the land for? And your client says, well, I was using it I was holding it as an investment. That's going to matter. The land today is worth $30,000, has an adjusted basis of 22. Okay, the first thing you need to determine is what type of property is this? This land is a capital asset because it's, it's not inventory, it's not trade receivables, it's not real property used in a trade or business. That's why I said it's important to know what she was using it for. It's investment property. She's held it 4 years, so that makes it capital gain property. It's appreciated, so we know it's capital gain, not capital loss. And she's held it long-term, longer than a year. So the first thing you do is you go to your first rule that we learned about property just a minute ago, and you said, what can she deduct, the 30 or the 22? Well, because it's a long-term capital gain property, she can deduct the fair market value, or the amount of the gift is $30,000. But now we have to go to these overall limitations that we looked at. Capital gain property and some private non-operating foundation stuff there too, and private non-operating foundation stuff here. Okay, so altogether she has a gift of $32,000, and now we need to know how much is deductible. What is she limited by? Just her AGI. 50% of AGI would be $30,000. During the TCJA years, though, it would be $36,000. So stop for just a second. I know y'all can do 30% times a number on your calculator, no biggie. Where students get tangled sometimes is 50% of what? 60% of what? Not of the contribution amount, but of AGI. So make sure you came down here and said either 50% or 60%, depending on what year it is and what rules Congress has, right? And again, not 50% of this, okay? So that's our first threshold. Well, the most she could deduct is 30 grand or 36 grand in 2025. Now we go to these other limitations. Well, this is capital gain property. So this 30%, we say 30% times, again, her AGI of 60,000 equals an $18,000 limitation there. Even though the rules say the gift amount is 30% of 60 is 18. That's all she's going to get to take for it. So her total deduction amount is going to be 18 for the land, 2 for the cash. It's not getting limited by this 30,000, $20,000. And of course, like I said, we've got to make sure we're underneath that amount. So hope that helps. Make sure you work through a few different problems like that. Oh, I know this is so long. There's so much with gifts, but this is super relevant. One last important problem that relates to gifts and really a lot of tax deductible things is, what is the after-tax cost of a gift? So say I write a check for $100,000 to my favorite charity. What is the after-tax cost of that? Physically wrote out that check for 100 grand, pulled 100 grand out of my bank account and gave it to them. It didn't really cost me that much though, because if that is a deductible amount, it reduces my taxable income by 100 grand, meaning I got to pay taxes on $100,000 less of income. So the after-tax cost is going to depend on whatever my marginal rate is. Say I'm in the highest bracket, the 37% bracket. Then my after-tax cost, I know I've got so much going on here. My after-tax cost, my taxable income goes down by this deduction. That's going to save me 37% in taxes. It's going to save me $37,000 in taxes. So my after-tax cost is 100 minus the 37. It really only cost me $63,000 to make that contribution. So you can see why wealthier people, clearly they've got more money so they can make more contributions, but their after-tax cost comes down a lot. If I'm only in the 10% tax bracket, then it's only going to save me $10,000, and the true cost of that gift would be $90,000. Okay, I think that's it. Gifts is a really large section, so spend some time and work a lot of problems on that.